Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
TPG Inc. is an alternative asset management firm founded in 1992 by David Bonderman and James Coulter in Fort Worth, Texas, originally focused on large-cap buyouts before expanding across multiple asset classes.
TPG's early deals defined its reputation. The Continental Airlines turnaround and the 2007 TXU Energy buyout, $45 billion, the largest leveraged buyout in history at the time, cemented the firm's brand.
Today, TPG manages approximately $230 billion in assets across 5 platforms: capital, growth, impact, credit, and real estate. The firm went public on NASDAQ in January 2022.
The most important recent development was the 2023 acquisition of Angelo Gordon for $2.7 billion. Angelo Gordon added roughly $75 billion of credit AUM, fundamentally changing TPG's revenue composition.
Before Angelo Gordon, TPG was heavily dependent on lumpy performance fees tied to deal realizations. Credit management generates more predictable, recurring fee-related earnings. That was the strategic rationale for the deal.
The Rise Fund, launched in 2018, is another differentiator. It's the world's largest impact investing fund, with over $20 billion targeting measurable outcomes across education, health, climate, and financial inclusion.
Institutional investors, sovereign wealth funds, pension plans, endowments increasingly allocate to impact strategies as part of their mandates. TPG's first-mover position in institutional scale impact is a meaningful competitive advantage.
The core private equity business operates at scale. TPG's brand recognition, network of operating relationships, and track record allow it to source and execute large deals that are effectively inaccessible to smaller managers.
On the financial metrics side, alternative asset managers are primarily evaluated on fee-related earnings and distributable earnings. FRE reflects the stable, recurring management fee business independent of investment performance.
TPG's management fee rate runs approximately 1.1% across its platforms. With AUM growing through both fundraising and the Angelo Gordon integration, fee revenue has a clear path to continued expansion.
CEO John Winkelried joined TPG in 2015 after a long career at Goldman Sachs, including serving as co-chief operating officer. His capital markets expertise has been central to TPG's IPO and public company positioning.
TPG's closest peers are Blackstone, KKR, and Apollo, all larger and longer established as public companies. TPG positions itself as a more focused, high-conviction platform relative to those scaled giants.
The distributions TPG pays reflect management fees and realized carry from investments. Payout levels move with deal activity, a structural characteristic of the alternative asset model that investors need to understand.
The firm has offices in 12 cities across 6 continents. That global footprint allows TPG to source deals, manage portfolio companies, and raise capital from institutional investors across major financial markets simultaneously.
That's the company chapter for TPG Inc. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
TPG Inc. had a rough Q1. EPS came in at negative 22 cents versus estimates of positive 61 cents, a significant miss. Revenue of $557 million fell short of $608 million estimated. The stock, which traded near $70, now sits at $44. This is what PE earnings look like in a market sell-off: mark-to-market losses and dried-up realizations. This is Charged Alpha. Let's break it down.
TPG is an alternative asset manager, market cap $17 billion. Founded in 1992 by David Bonderman and Jim Coulter, TPG went public in January 2022. The firm manages approximately $224 billion in assets under management across private equity, growth equity, impact investing, real estate, and credit. Revenue is driven by 2 components: management fees, stable and recurring, and realized carried interest, lumpy and market cycle dependent. The management fee base is growing as AUM expands. But Q1 2026 exposed the vulnerability. When markets sell off and portfolio companies mark down, both the carry economics and the appetite for new realizations evaporate simultaneously.
The Q1 miss was driven by two compounding forces. First, mark-to-market losses on the equity portfolio. The broad market sell-off in Q1, driven by tariff announcements and recession fear, produced unrealized losses across TPG's private equity holdings. These losses flow through the income statement under current GAAP accounting for alternative asset managers, converting portfolio volatility directly into reported EPS volatility.
Second, realization slowdown. Carried interest is only earned and recognized when investments are monetized through IPOs, M&A sales, or secondary transactions. In a volatile, risk-off market environment, exit windows close, IPO markets freeze, M&A buyers become cautious. The Q1 realization pipeline essentially dried up, cutting off the carry income that powered Q4 2025's strong 50-cent EPS. Q4's $1.49 billion in revenue was primarily carry-driven, exactly what Q1 lacked.
Management fee revenue is the stable anchor. TPG earns management fees on committed capital and invested capital across its funds, and that fee stream is contractually obligated regardless of market conditions. As AUM grows from $224 billion toward $300 billion over the next several years, driven by fundraises across PE, impact, and credit, the management fee base compounds. The bear case is about carry timing. The bull case is about fee-based growth.
Cash flow and balance sheet. Operating cash flow was $177 million for the quarter. Free cash flow was $160 million. Cash stands at $851 million against debt of only $600 million, a net cash position that is unusual for the sector. Equity of $3.7 billion. TPG's relatively clean balance sheet versus peers like Apollo and KKR is partly a function of its later IPO date. The balance sheet has not been leveraged to fund co-investments at the same scale as incumbents.
The quarterly revenue trajectory illustrates the lumpy nature of PE economics. Q2 2025 was $700 million. Q3 was $840 million. Q4 2025 delivered $1.49 billion on a surge of realized carry as M&A windows briefly opened. Q1 2026 at $557 million is the cycle repeating. Management fee revenue, the stable component, ran approximately $300 million in Q1, providing the floor beneath carry volatility. TPG trades at approximately 12 times forward 2026 distributable earnings, the most relevant metric for alternative asset managers, which strips out mark-to-market noise and focuses on cash actually distributed to shareholders. At $44 against a 52-week high of 70.38, the stock has given back roughly 37% of its peak value. That drawdown has created what some analysts call a compelling entry point, or what bears call fair value in a low realization environment.
Peer context. Blackstone trades at 20 times distributable earnings, the premium for scale, brand, and AUM diversification. KKR trades at 14 times. Apollo trades at 12 times. Carlyle trades at 10 times. TPG at 12 times is roughly in line with Apollo and above Carlyle, appropriate for a firm with AUM growth momentum but less scale than BX and KKR. The key debate is whether TPG's impact investing franchise and growth equity focus command a premium or discount relative to traditional PE peers.
The stock has the ingredients for a significant re-rating if market conditions improve. From $44 back toward the $70 52-week high would represent a 59% gain. That recovery depends on equity market stabilizing, removing mark-to-market drag, realization activity resuming, generating carry, and fundraising continuing, growing the fee base. All three are plausible over a 12 to 18-month horizon.
3 reasons to be bullish on TPG. First, the fee base is growing regardless of market conditions. $224 billion in AUM growing toward $300 billion on new fund cycles generates compounding management fee income that does not depend on equity markets. Second, the carry pipeline is building, not depleting. Unrealized gains in the portfolio accumulate. When exit windows reopen, in a lower rate, more stable market environment, a significant backlog of carry will be recognized. Third, valuation at 12 times distributable earnings is near a cycle low. Buying alternative asset managers at cycle lows has historically been one of the most rewarding financial sector trades.
3 reasons for caution. First, the earnings model is fundamentally volatile. TPG's Q1 demonstrated that a market downturn converts EPS from positive 60 cents to negative 22 cents in one quarter. For investors who require earnings stability, TPG is structurally incompatible with that requirement. Second, realization windows may stay closed longer than expected. If tariff-driven macro uncertainty persists through 2026, IPO and M&A markets may not recover sufficiently to generate meaningful carry realizations. Third, competition for LP allocations is intensifying. Blackstone, Apollo, KKR, and Ares are all raising capital aggressively from the same institutional LP base. TPG's impact and growth equity differentiation may not be sufficient to maintain its fundraise velocity as competition intensifies.
The alternative asset manager peer group is dominated by Blackstone, BX, market cap $200 billion, KKR at $90 billion, and Apollo at $80 billion. TPG at $17 billion is smaller than all three. Size matters in alternatives. It drives LP relationships, co-investment capacity, and brand recognition in competitive deal processes. However, TPG's impact investing franchise through the Rise Fund and its technology growth equity focus give it differentiated positioning that the mega managers cannot fully replicate. The question for investors is whether that differentiation is worth a premium, parity, or discount relative to peers at current AUM scale.
Apollo is the most instructive comparison. Apollo built its empire on credit, a steadier revenue source than pure PE carry, and the credit-heavy mix is why Apollo commands the same 12 times distributable earnings multiple as TPG despite being nearly 5 times larger by AUM. TPG's path to a premium multiple requires either demonstrating durable fee stream growth through new fund cycles or opening a credit platform that reduces carry volatility. The Rise Fund credit and real estate sleeves are early steps in that direction. For now, TPG trades at a scale discount to BX and KKR that is rational at the current AUM level. Options activity on TPG was bearish ahead of Q1. The put-call ratio ran above 1 as traders positioned for the earnings miss driven by portfolio markdown risk. Implied volatility was elevated at approximately the 85th percentile for the financial sector, correctly pricing in the binary outcome between a strong carry quarter and a weak mark-to-market quarter. The miss confirmed the bear thesis in the near term. Post-earnings, some investors began building long positions in call spreads at higher strikes, betting on realization recovery.
On insider activity, TPG co-founders David Bonderman and Jim Coulter retain significant ownership stakes, aligning their financial interests with long-term AUM growth rather than quarterly earnings volatility. No major insider selling was filed in Q1 despite the stock's decline from near $70. The absence of insider selling at $44, a 37% drawdown from the high, is a constructive signal that founders view the current price as temporary. Institutional holders include growth and value funds that bought the IPO and have held through the cycle. Bottom line on TPG, the Q1 miss reflects the structural volatility of the alternative asset manager earnings model, not a fundamental deterioration of the business. Management fee revenue is growing, AUM is compounding, and the carry pipeline is building. The stock at $44 versus its $70 high is a bet on market normalization and realization window recovery. For investors who understand the PE earnings model and can tolerate earnings lumps, TPG at 12 times distributable earnings is an interesting entry point.
Charged Alpha is produced for entertainment and education only. Nothing here is financial advice, and we are not licensed financial advisors. Always consult a qualified professional before making any investment decisions. Past performance does not guarantee future results. The hosts and production team may hold positions in securities mentioned. Trade carefully.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.